Welcome to Daily Digests for July 21st, 2026. Institutional sentiment in U.S. equities received a major boost today after regulatory filings revealed that Berkshire Hathaway has built a massive position in Alphabet, valued at over $30 billion. This single move marks a significant pivot in Warren Buffett's investment strategy, signaling strong institutional confidence in big tech's artificial intelligence infrastructure spending. For decades, Warren Buffett favored capital-light businesses with high returns on invested capital. Alphabet, however, is spending upwards of $75 billion annually to build out its artificial intelligence computing stack. Berkshire's willingness to step in reflects Alphabet's strong profitability baseline, highlighted by a 31.8% return on equity, proving that massive capital expenditure can coexist with high operational returns. This institutional accumulation comes as tech megacaps face valuation scrutiny after a prolonged rally. Rather than pulling back from high multiple growth, long-term capital is concentrating into companies that control their own infrastructure and compute pipelines. For equity investors, Berkshire's position provides a clear vote of confidence in the long-term earnings power of hyperscale infrastructure. While private capital reinforces big tech balance sheets, sovereign risk inside the artificial intelligence stack is rising. The Department of Defense formally designated Anthropic as a national supply chain risk following a dispute over military use cases. This marks the first time a domestic software provider has received such a designation, setting up a legal clash that could reshape how private labs interface with government defense contracts. Sovereign oversight is also reaching model deployment timelines. Federal national security officials requested that OpenAI stagger the release access for its upcoming GPT 5.6 model. This intervention highlights growing government involvement in frontier model deployment, introducing new regulatory timing considerations for commercial AI rollouts. These policy moves fit a broader pattern of direct government involvement in critical technology. Over the past year, the U.S. government has taken equity stakes and convertible warrants in domestic hardware and materials suppliers, including Intel, IBM, and MP Materials. Federal policy is actively shifting from passive oversight to direct participation in national technology supply chains. In credit markets, tightening conditions are starting to reach even high-grade corporate borrowers. Amazon's recent $25 billion bond offering saw demand coverage of 1.6 times, noticeably below the 4.0 times average typically seen in U.S. investment-grade debt issuances. This reflects growing investor discipline around corporate borrowing costs as interest rates remain elevated. The cooling in bond demand arrives after a historic borrowing wave. AI-related debt issuance has reached $270 billion so far in 2026, nearly double the total volume recorded across all of 2025. With direct lending issuance down roughly 40% in recent months, lenders are becoming far more selective about funding capital-intensive growth projects. Across broad U.S. equity indexes, market positioning remains sharply divided. Short interest on major benchmarks has approached multi-month highs, creating the conditions for potential short squeezes, while retail margin leverage remains near record levels. Traders face a volatile tape, driven by mechanical positioning shifts rather than smooth fundamental trends. On the regulatory front for public equities, SEC Chairman Paul Atkins outlined plans to streamline registration requirements and reduce listing costs for growth companies. By moving away from enforcement-led regulation toward clear disclosure guidelines, the SEC aims to reopen the U.S. IPO window and encourage more private companies to list publicly. Meanwhile, enterprise software leaders are adapting to changing cost structures. Microsoft is navigating an infrastructure-heavy transition as it expands cloud capacity to support corporate AI demand. While capital intensity compresses short-term growth margins, enterprise commitment to cloud workloads continues to support long-term revenue visibility. In consumer media, Netflix is completing a transition from pure subscriber growth to a cash flow-driven compounder. Investors are pricing the stock less on quarterly subscriber additions and more on durable free cash flow generation and share repurchases, offering a steady anchor inside dynamic growth portfolios. To wrap up today's digest for July 21st, watch Alphabet's key technical levels following Berkshire's entry. Track corporate bond spreads as high-grade debt issuers adjust to tighter demand, And monitor upcoming big tech earnings for updates on capital expenditure efficiency. Thank you for listening, and we will see you tomorrow.